You've probably heard the news say the stock market is hitting new highs, then stepped outside and wondered why everything still feels so expensive and uncertain. On TV, it's treated like a scoreboard for the whole country, but in reality, it mostly tracks the value of big listed companies and the investors who own them, not the day to day reality of most workers and small businesses. This video pulls those two worlds apart and shows how soaring charts can sit right next to layoffs, tight budgets, and struggling neighborhoods, and what that disconnect actually means for your life and your money. In the past 10 years, there have been stretches where stock indexes climbed to all time highs while regular people were dealing with hiring freezes, rent hikes, and grocery bills that kept creeping up. Large publicly traded companies, especially in tech, finance, and healthcare, were reporting record profits, buying back their own shares, and rewarding investors, even as small local businesses were closing and many workers were piecing together multiple jobs just to stay afloat. You can have a rally driven by a handful of giant firms that dominate the index, so the chart looks like everything is booming, but that says far more about those specific companies and the investors betting on them than it does about whether your town is thriving or your paycheck is keeping up with inflation. What most headlines call the market is really a weighted snapshot of a few hundred big corporations whose shares trade on public exchanges, not a census of the entire economy. Indexes like the S&P 500 are tilted toward the largest companies. So when a small group of mega caps jumps, think global tech platforms or dominant consumer brands, they can pull the whole index up even if thousands of smaller firms are struggling or closing their doors. Millions of workers earn their income from small and mid-sized businesses that are not listed anywhere, yet they provide a large share of new jobs and local economic activity, and none of that shows up directly in the stock averages you see on the news. On top of that, stock prices are built on expectations and sentiments, what investors think earnings, interest rates, and policy will look like 6 to 12 months from now. So the market is constantly voting on a possible future, even if the present still feels like a slowdown for most households. Most people's economic reality is shaped not by giant corporations on a stock index, but by the small and mid-sized businesses that line their streets and employ their neighbors. These companies, local restaurants, contractors, repair shops, clinics, logistics firms, create a large share of new jobs and keep money circulating through communities, yet almost none of them are publicly traded or reflected in the daily movements of major stock indexes. When a neighborhood loses a few key employers or when wages stagnate in these smaller firms, the damage to household finances is real, even if the stock market is rising because multinational corporations are doing well. For workers, the disconnect goes even deeper because their main economic touchpoints are paychecks, hours worked, rent, and the prices of essentials, not the value of shares on a screen. If overtime gets cut, health insurance premiums rise, or local housing costs jump faster than wages, life gets harder, even in a period when stock portfolios are growing for people who own a lot of equities. This is why a booming market can feel almost invisible to large parts of the population. The gains are concentrated in company valuations and investor accounts, while most workers experience the economy through job quality, job security, and cost of living instead. Another reason the stock market can drift away from everyday economic experience is the influence of central banks and interest rates on asset prices. When policymakers cut rates or inject liquidity into financial markets, borrowing becomes cheaper and investors often shift more money into stocks and other risk assets, which can push prices up even if wage growth is modest or certain sectors of the economy are still weak. Low interest rates also make future corporate earnings look more valuable in financial models. So expectations of easy money can inflate stock valuations independently of what is happening on the ground for households and small businesses. At the same time, the benefits of rising asset prices are heavily tilted toward those who already own stocks and real estate, which tend to be higher income and wealthier households. For people living paycheck to paycheck, cheap money might show up as easier access to credit cards or car loans rather than as a growing portfolio, and that extra credit can even make them more vulnerable if rates eventually rise or jobs are lost. This dynamic helps create a world where financial markets are celebrating because money is flowing and valuations are climbing, while many families are still focused on rent, groceries, and keeping up with debt payments, again reinforcing that the market's mood and the economy's lived reality are not the same thing. Stock prices are not a live dashboard of how today feels, they are a running guess about tomorrow. Investors constantly try to price in what they think corporate profits, interest rates, and government policy will look like 6 to 12 months from now. So markets often move on expectations before regular people see any change in their paychecks or job prospects. That is why you can see stocks jump on news that sounds bad in the moment, like a weak jobs report, because traders are betting it will push central banks to cut rates later, which could boost profits down the line. In the same way, good economic data can sometimes trigger a sell off if investors fear it will lead to higher interest rates. The market is reacting to the second order effect, not the headline itself. This forward looking nature means the stock chart you see today is more of a prediction machine than a reflection of the present, which is one more reason it often feels out of sync with everyday economic life. The fact that the stock market is not the economy doesn't mean you should ignore it. It means you should understand its role and keep it in perspective. For long term investors, broad stock exposure is still one of the main ways to grow wealth over decades. But it works best when you treat it as a tool for the future, not as a daily scoreboard for how things are going right now. That starts with building a base, steady income, an emergency fund, and manageable debt, so that market ups and downs don't decide whether you can pay rent or buy groceries. Once that foundation is in place, you can use diversified stock investments as a way to participate in corporate growth over time, knowing that the ride will be bumpy, but the goal is measured in decades, not news cycles. At the same time, keep reminding yourself that owning stocks does not replace the real economy they live in. A healthy financial life still depends on skills, career choices, local job markets, policy decisions, and the cost of essentials, none of which automatically fix themselves just because an index is up. The most powerful position to be in is understanding both worlds, using the market to build long term wealth while staying grounded in the reality that your day to day security comes from work, community, and policy, not from whether a line on a chart happened to close green today. Hope you guys enjoyed the video. There's plenty of more valuable information on the way, which I think you guys are really going to like. Stay tuned, and I'll catch you all next time.